Hello everybody, continuing from our previous video where we've looked at the theoretical basics of how to create next year pro forma projections for the income statement and the balance sheet, and you were given an example to work through. We're going to go ahead and work through this example. First, you needed to create historical information, and this was just supposed to double check your understanding of what's happening on the income statement and the balance sheet. So you sold $100 in shirts. Let's say you sold 10 shirts at $10 each, and you had to pay 65% of that 100 in cost of materials, some really nice materials, thread, etc. So your gross profit here is going to be $35. Then you spend 28% of sales as operating expenses. These are things such as electricity in the factory, paid to your secretaries, advertising campaigns for your shirts. And so your operating profit is going to be $7. You also paid 60 cents on interest on your debt, and these are all hypothetical numbers, so you can think that this is in thousands, so this is 100,000, for example. Your taxable income is then operating profit or EBIT minus the interest. 21% tax is paid on this taxable income of 6.4, so you're going to pay 21% on your taxable income. And this brings us to the biggest summary in accounting: earnings or net income. These are all historical numbers, so this has already happened. 32% of your net income you pay out as dividends to your shareholders, so what's left over is $3.40. So after selling $100 worth of shirts, you're going to reinvest $3.40, what's left over from the sale of $100 minus all of the cost, $3.40 back into your business. So that is built in here in this shareholders' equity. This $3.4 is already reflected in there. For historical balance sheet information, we only need to come up with a total assets total, which is a sum of all asset accounts, cash, inventory, accounts receivable, and net fixed assets. And then for total liabilities and shareholders' equity, we're going to add through my debt accounts, accounts payable, notes payable, and long-term debt, and through my equity accounts, common stock, and retained earnings. These are this is an equity that's generated really by company reinvesting its earnings back into itself. All right, so you can see that here our balance sheet is balanced. Total assets equals liabilities plus shareholders' equity. Everything is correct. Let's create next year's projection, assuming that our sales will grow at 10%. So instead of selling $100, I'm going to sell $110, okay? My cost of goods sold will also grow at 10%. How do I know this? If you don't remember, you can take a look at our cheat sheet that we created in our theoretical foundation last class. So this is also growing with sales at 10%. Next, I have a sub-summary. That's my cost of goods sold. My operating expenses are also going to grow with sales at 10%. Again, all of this makes sense because as you're selling more shirts, you need to have your factory lights on for longer in the factory, and you need your sewing machines to be running longer. This brings us to our operating profit next year. For interest, we're going to keep the interest unchanged. So this is going to be the same as in the previous year, which gives us our taxable income of EBIT minus the interest. 21% of that is going to be paid as a tax to the government. And then the biggest sub-summary of them all, net income, is my taxable income minus the tax. Out of that, I will pay 32% to my shareholders in the form of a dividend, and what's left over will be reinvested back in the company. So I will make $110 from selling my shirts, spend money on a variety of costs, and at the end will reinvest $3.80 back into my business. So the first account we will project on the balance sheet will be the internal capital account, where you're investing this $3.8 into your company. Because balance sheets are cumulative, we're going to add that 3.8 from the income statement to the balance sheet. So my next year retained earnings in the pro forma should be $23.08. Before moving on to asset accounts, and because I have already created this account, the interest account, which was the external financing account, I'm just going to go ahead and project my external financing account, so building up from my retained earnings here. All of them will remain unchanged. This is so because I'm trying to figure out whether I need external funds in the first place. And now let's go ahead and go in order with the asset accounts. As we've said, in the simplest projection, all of them will grow with sales. So my cash is going to grow with sales at 10%. My inventory will grow with sales at 10%. This makes sense because I need to have more inventories as I sell more shirts. My credit to my customers, my accounts receivable will grow at 10%. Makes sense. I need to give more credit to customers as my company grows. And my equipment, things like my sewing machines, are going to grow at 10% because I'm going to need to probably buy more sewing machines to sew more shirts. In total, my total assets are a sum of cash plus inventories plus accounts receivable plus net fixed assets. So my total assets grew from 40 to 44. Imagine if this was in million, you grew from 40 million to 44 million. And this growth in assets is needed to support this 10% growth that you're expecting in sale. All of these accounts are increasing just to make sure you have enough shirts to sell. And you need to come up with additional $4 to fund all of these additional asset needs that are needed to support additional sales. Let's look at the liability and shareholder equity accounts here. We have most of them filled out except for accounts payable. Remember, accounts payable, accounts receivable, and inventory are operating accounts right here, operating working capital accounts. You need them to run your business day to day. So all operating accounts will always grow with sales. So my suppliers will give me more credit as I'm buying more material from them to sell more shirts. So this will grow at 10% as well. Now I need to summarize my liabilities and shareholders equity accounts, and I come up with 44. So how do I know what's my EFN? Well, I need to look at my total assets minus my liabilities and shareholders equity, and I'm coming up with 0. So I don't need any external funds. My balance sheet is balanced, and this internally generated retained earnings, my internal funding, is enough to fund a 10% growth next year. Now, let me ask you a quick question. What if the sales growth was 20%, not 10%? Do you think this firm would need to borrow external funds? Take a moment to think about it. When you're ready, unpause the video and take a look at the answer. If the firm is growing at 20%, I'm just going to change my growth rate up here because the statement is interlinked. Everything should fall in place. My sales have grown, so have my internal funds. But look, now I need to have $48 in total assets and $8 increase from the previous year to support this 20% growth in sales, selling 20% more shirts. But I only have about $4 coming in from internally generated funds. So you can now see that my total assets next year are projected to grow more than I can afford with my internally generated funds. And I have a need for external funds of $3.4. This means this company will need to borrow $3.4 or $3.4 thousand or $3.4 million next year in order to support 20% growth. The next question is, how is it going to borrow that $3.4 or $3.4 million? And the firm is going to raise debt. External financing that is going to raise is going to be debt. It's going to raise either short-term debt or long-term debt. And the way that the company will raise these external funds will depend on maturity matching, meaning it will depend on what has happened to its short-term and long-term accounts. But that's for the next video, maturity matching and which funds to get. In this video, we've looked at the example of your Pro-Forma, created a historical income statement and balance sheet, and then also worked through a scenario of 10% sales growth where internal funds were enough and 20% sales growth. Next, go ahead and take a look at this Pro-Forma To-Do tab. You are given an income statement and a balance sheet here, and you are asked to create an income statement and a balance sheet Pro-Forma. Go ahead and complete those at 20% sales growth as well as you can, and double check your work against this Pro-Forma solved where you're given historical information and the Pro-Forma that we created, that you will create, already solved. Good luck.